Scott, what's going on?
What's going on, Nate?
Master list puller?
Yeah, I mean, it's something.
You've been doing this for a while.
Right, yeah. Learned a lot of tricks and techniques that are, typically fly under the radar for a lot of people. Inside of lists, you'll hear me say all the time that no lists are created equal. No list providers are created equal. There's holes and anomalies nationwide. I mean, one of the quick things I found the other day was just inside of Utah, that they don't call them absentee owners, they call them absentee in-state owners.
Oh, really?
So just that little bit of verbiage change will change how the filter filters it inside of a different list provider. So you might be missing in data just on something as simple as that.
Okay, that makes sense. You've taught me a lot since I've been here, but I'm always learning.
Right.
So I do have a couple of questions, and I'm sure everybody else would like to hear them as well.
Sure.
So just while I got you here.
Right. I'm constantly learning too. So that was something I learned yesterday.
Yeah. Yeah, you don't want to stop.
Right.
What are some signals that I guess most people overlook when it comes to, looking at lists or when they're list pulling? What are some things people overlook?
Yeah, anytime you're pulling a list or if you're, having somebody pull that list for you, you always want to keep an eye with that data provider. It'll give you a running tally of how many are available. So anytime you make a change on a filter, you want to look and see how that affected your total. Most people are educated real estate professionals in their area, and they know their area pretty well. So they can go, and if they change to absentee or if they change years of ownership, they should kind of know where that number should go in a range. And if it really drops off substantially, there's a problem with that filter in that area. It could be as simple as something that years owned. Typically don't go back in, most counties nationwide only go back 25, 30 years of digital data. So anything prior to that is an unknown because it's a blank in the column. But the problem with all data providers is they just simply see that blank as a zero. We have to think that how it's filtering it, is it filtering it correctly? Do we have the data to be even able to filter in that area? So always pay attention to the number on the one side every time you change a filter, because if it substantially drops off or doesn't really change, then maybe that filter's not working.
That makes sense. Why do most investors end up chasing the same obvious data points?
Well, it's the golden ticket thing. As we all say, what are the key ones? And these too. It's probate inherited. It's pre-foreclosure foreclosure. It's tax delinquent. I call them the golden words. Everybody's on them. It drives competition to them because that's where we find most of the deals. But the problem is if we get saturated with competition, it's hard to get the deals because so many people are after them. And where we need to find is in every area, people speak a little bit differently. They use different lingo, different language, different in the Northeast than the Southwest. So what words you guys use in that area, and you want to make sure that those words are being used with that data filtering process. So it's things as simple as intrafamily transfers. They don't use that in the Northeast. So if you go in there looking for intrafamily transfers, you're not going to find them. So there's always little variance inside of a data set and a data company. You want to split test a lot of data. Data companies to find out which one's the best in your area and fine tune that thought process as you go through it.
I did have a really good question because we were having a conversation the other day. This kind of came up. Do you have any deals that you can point to from a client that came from a signal that most people overlook?
Mm-hmm. Yeah, I mean, it's in certain situations, it's usually more about the geography of what's available in that area, or something that has less competition or is harder to find. A couple years ago, it was unknown sales date. Everybody would say, hey, we needed them to own it 1, 3, 5, 7 years for the house to get distressed, to get out any flipped properties. We started to go after that unknown sales date. And then as we've come up closer to things, in the last year, intrafamily transfers got really hot. And why that is coming out of COVID, everybody stopped building new construction. So the family started buying up all the probate, as that property came available in their family, they bought it up. Well, now they're springboarding off of that with the new construction, using the appreciation in that house and the fact that they bought into it fairly low. They're coming off that intrafamily transfer to use that as a springboard to buy a new construction. And so we're seeing a really good uptick in that. And it always flows with conversation inside of local REIAs. You want to get into those local REIAs and kind of just start asking questions. What are you targeting? That's where the competition typically comes from, is if they're targeting this, yeah, you want to have your toes in the water with that, but you want to find out what they're targeting so you can step just outside of bounds of where they're playing. So, it might be 50% or more in equity. Maybe you can go 40. Maybe it's year built, you go 1 year difference. So you get just outside of the competition where you can find a lot of different properties. And AI helps with a lot of that too.
Okay. You did say something that was pretty interesting about even those people that are calling in saying, take me off the list, right? Something to where, there's something there.
Right. Well, we're targeting inside of a list. This is a common mistake a lot of people do. And so even some of my bigger competitors have, or bigger clients have, do not mail list 40,000 deep. They've been building it for 10 years. And I'm like, we need to mail the do not mail list. At first doesn't sound like it makes sense because it's on a do not mail list. But of that, we've had turnover. They're motivated sellers. We've targeted them for a reason. And one of the big things on that is, often people don't want to be confronted with what their problems are. And when they get a mailer or a phone call and that saying, hey, do you want to sell your house? They know they're distressed. They know they're either financially or physically distressed in some way, but they don't want to fess up to it. So they're going to be combative off the beginning. So you want to have that, start to lean into that conversation to retarget them with a softer approach. Say, hey, when you're ready, or yes, I can take you off the list, but if all the honest investors take you off the list, you're just going to be left with the dishonest ones or the new ones. So that being said, can I retarget you in, say, 6 months just to let you know I'm here? Eventually you're going to sell. Might not be to me, but it'll be to somebody, or, some situation is going to come across. There's all inevitable, there's going to be turnover. But inside of that list, you want to retarget that occasionally because they're on a motivated seller's list. Okay. So their likelihood to sell, but we just might not be to you, might not be to somebody else, or they might not want to admit to it. So they're a little more combative about it.
How do ignored signals in lists help newer investors? We kind of touched on it a little bit ago on the last one.
If explain that question a little more. Like, you're meaning that they're skipping over certain things or they're staying away from certain things?
How do signals that the big guys are ignoring help the smaller investors if they were to focus on them, right?
Oh yeah, it's the thing with competition is everybody is drawn to like a moth to the flame. They're all going to where they hear that people are finding deals. But with AI technology nowadays and, better list filters, you can go in and find what they're missing. So it's kind of like going into the Yukon with better equipment. You're able to find the gold that the other people are missing that's spilling out over the top because, most of the higher competition or the bigger investors, they're paying premium data, but they're mailing in, vast areas. They're painting with a really broad brush, but only going after the cream at the top. But there's a lot of deals in that middle that most people miss on. And if you can start to target that middle that the investors are missing or outside of the parameters of what they typically do, just get outside of their norm, ask them a lot of questions inside of the local REIAs or masterminds. And then you can use that to your advantage and dive deeper into the data and find what properties are likely to sell, but they don't quite match, what that big investor's going after, whether it's, maybe it's, you get more into mobiles. There's a big push of a lot of investors nationwide that are starting to flip mobile homes because, it's affordable housing. You go where the competition isn't, and that's where a lot of the money is to be made and get to be the best in that field. One more thing to add on the mobiles is inside of that data set where a lot of mobile home list pullers are missing is, the scraped lots. They're like, I don't want a vacant lot, but it has all of the entities there sitting there, as far as the well, the septic, or the sewer, and all of that's there. Somebody just took the old trailer out, and you can bring in a brand new home, drop it in there, do a little bit of landscaping, and have a quick flip and, a pretty good turnaround pretty quickly. So, of every data set that you're targeting is going to have anomalies. You just have to figure out or sit down with, one of us coaches to figure out what's the best data set for that in just your area.
How does certain signals change, who you mail and how often you mail?
Well, that's, signals or motivated sellers, that we're targeting. You can have that middle ground where we're going to paint, like with that broader brush that if they're not highly motivated or not in that, upper cream of the list that have multiple flags, say you're in a whole county, you're finding any deal that's in a whole county, and we have a lot more data than we have budget. So then we're going to touch everybody one time, over a 3-month period, so we can touch more doors. But if you're at that point where you're in that middle ground and you have more budget than you do data, then at that point you're going to mail them, once or twice a month. But then you can bring in the courthouse data, those the evictions list or divorced and stuff like that is highly sought after, some of the best data that's out there. Then you want to get that speed to lead, especially on foreclosures that has a date pending. You want to touch them 2 or 3 times in a month to let them know that you're here to help. And with various different styles of mailers that, hopefully get through to them to generate that inbound call that you're there to help them.
We basically have a list that we hit regularly every month. And then also, a pre-probate list or pre-foreclosure list that we're going to hit twice a month.
Yeah. So the Liz Pendants lists are great. As far as, targeting them, once or twice, a month. But then when you get into the foreclosure ones where there's a date pending or a tax delinquent auction date, any of those ones where there's a date pending, you want to get after them a bit faster. And then probates is kind of lean into it, is you're like, hey, we know there's an issue. But oftentimes people don't understand the process and they need help with that. So, maybe cultivate out, a checklist for them and send that to them in the mailer, and a little bit longer winded first touch to say, hey, simply here to help. These are all the things that I've found over the years of doing these and helping people get through this process. So here's a simple checklist of things that you're going to need to know, and maybe even a page just on the definitions of words that are in there. And by just leaning into them that way, you're going to build, trust and rapport to get to be the person that they go to for answers in that area.
The Q4 was kind of slow for a lot of people. It was kind of a weird quarter, it seemed like. So, if you had a smaller budget and you were going after that one deal, you could get that deal opportunity, but a weird thing happens and, weird thing happens at the closing table, right? And you couldn't make the deal happen. The lady didn't want to finally move out.
Yeah, or title issue or something.
Title issue,
yeah.
Kind of wanting to just sell it to his brother or give it to his brother. So it was kind of a weird quarter. But then, my guys that had a little bit higher budgets, even though it was a slower quarter, they were still able to make money because they were going after that 2 to 3 deal a month number versus like 1 deal a month, right? So that helped them out big time. The guys that were kind of going after that 1 deal a month, I think we just need to add a little more motivation to them, to those lists, because, throughout the year it was working out great, right? But then around the holidays, it kind of slowed down. So it really, I guess you would say, shined a spotlight on, either if you weren't closing well or if you were used to those easier deals or that higher call flow.
Sometimes it's just staying consistent, touching, more doors, diving deeper into an area, if your geographical area is smaller. So, if you have a small area that, we're finding a lot of properties in. So, if you take those properties on the back end that you already know you're getting your deals, so of your deals, you refunnel them or recycle them to the front to say, okay, where did we find the deal? What was the deal? What caused the deal? Dive deeper into the seller. And they're going to give you a lot of information inside of that. And when that seller starts to speak to you, take notes on why they were selling. And then you bring that to your list provider and say, hey, of this, I find that these are their pain points. Can we find more of them? And if you give the direction to your list provider, a lot of times they can go find more of those properties, but you got to be careful there, because too many times we want to go, oh, all of our deals were in this little bitty avatar right here. I only want to hit that. But then what happens is the market moves. If the market moves from that little bitty avatar, now we're playing in a different ballpark. And we're not getting that lead flow. So it's always good inside of data to just be a little bit bigger than what our target is. So if the market moves, we're still kind of staying in there. We can start to move with it. Make small moves instead of, too many clients out there like, oh, we're going to change all of this. Well, then they don't know, what they changed or what portion of what they changed their list. So that's a big thing there is not making too many changes too fast. Stay consistent. Direct mail has a slow and low approach to it. Over time always has some of the best ROI. And in doing that, you want to kind of make your movements kind of like direct mail and not overanalyze what a response rate is too fast. Because too many people will start at the end of, like you just alluded to with Q3 and Q4, but they'll start at the beginning of Q4, which is some of the lowest response rates, and go, this doesn't work.
Right.
But then in Q1, they're still getting residual phone calls as people pull their head out of the sand. And in doing that, then they'll call us back and be like, oh, no, it does work. We need to turn it on. But then they're starting over again, and they didn't put any mail on the ground in Q1. So consistency is king. Track your KPIs. On the backside of that, know where your deals are coming from so you can go find more of them in similar markets.
What lists do you see working best for you in those challenging times?
Typically, anytime you can get the fresher the data, the better. So as soon as that low-hanging fruit comes out of the courthouse data is always great. If you know that a certain area is providing, we have a high turnover, maybe an elderly, or it's an absentee market, and then all of a sudden, the taxes went up, or your insurance premiums are going up, as they always do, or at the end of the year that we have taxes due. So in those markets that are absentee owners, they'll sell off a couple properties like trading cards to cover the tax bill. And then the next year, they'll just replace them with something else. Evictions are great. Any of that fresh stuff. So as, know your market of what it's providing and then go after those style of leads. Bring that, make sure you're consistently hitting those or staying on top of them. But anything fresh out of the courthouse is great. We have our shipwreck list that is that way, but it's a premium list. So it's going to cost a lot more. It's either going to cost time and effort of sweat equity to go get it yourself and procure it and then convert it. To where it's mailable or callable, whatever you got to do to that, or you have somebody do it for you, but they're going to charge you a premium because they're doing the work to it. So those lists, on smaller lists are great. You get a great response rate and a lot of motivation inside of them. And then as you get into the broader list approach, then you're getting into, finding out who's selling what in that market. Does that make sense?
Yeah. What do you think? A lot of people like to target absentee owners. What do you think about throwing in some owner-occupied?
You want them to have motivation. So, the longer they lived in it, of the elderly, and this is a great one with owner-occupied, you want, seniors, because they're going to be transitioning either into retirement or to, a retirement home or moving in with family. At some point, they can't maintain the property, either physically or financially. And of those two things, physically or financially, also creates a distressed homeowner, which are great to target, hard to find because of the age demographic that it's not typically out there to do, but you can typically do by years of ownership on the house. But going back to the beginning where, most counties only report back to 30, you want to add in the unknowns or just only target the unknowns that have owned it for over 30 years, of the county records, PropStream, ListSource, our data with Smart AI. We have the unknown filters. Certain people do, certain people don't. So, but you want to be adding them on the senior owner occupieds.
Okay. You think if they're building a lot of retirement centers, you think that'd be a good place to target those senior owners?
I think it's more, along the lines of when the subdivisions were built. You can kind of look at that when the growth happened, that, if it's 30 years ago that subdivision was built, and that was a lot of new buyers buying into that as it was. And then you can kind of go back in and look at an individual subdivision if it has had turnover. So just randomly pull houses in the neighborhood and see how long they've owned it. Like I bought my house was built in 99. We bought in 2017. We had, quite a few elderly living in it. It was 50-50. Now it's like 70-30 because they're starting to transfer out as that house becomes 30 years old.
Yeah. Even the neighborhood that I grew up in, I mean, a lot of the people bought in there when it was brand new.
Right.
Don't live there anymore,
your parents
but
being one of them.
Yeah. So every once in a while when I'm over in that area, I'll drive through and see, do the Mitchells still live here?
Right.
So it's kind of cool to see that, but that's a really good thing to look at.
And that's something to talk to local realtors about if you're just on the investment side or if you're a local realtor. But, you're going to know the pulse of your area, which communities were built when, where the turnover's happening, where the growth is. We always look for, flippers like to buy where good school districts are. A lot of renters, if they're not going after those A and B, they're going after those Section 8 properties. You can go and see which areas have the most absentee owners. Those are great to find more Section 8 properties because it's going to be a lower price point. So there's little things inside of all list provider or all list pulling techniques in every area that are unique to that situation, and you can start to pinpoint them and pull them forward.
Okay. To touch on that owner-occupied, I had a guy in Virginia, and we were hitting absentees for a long time. We added in an owner-occupied list, and the guy that called in said everything but divorce. So we basically got to a divorce before it was showing. Right. He was getting rid of the house, getting rid of the wife, the cars. He was getting rid of everything, right, on the
Yard
phone.
sale.
So he was fired up. But, that was a really good list to hit. And I thought that was pretty cool to get to that divorce or that tough situation before it's showing for everybody else.
Right.
Right.
And that's sometimes as easy as, getting a hold of some high-end divorce lawyers, putting a $20 bill on the backside of a business card.
He wasn't even getting a divorce yet.
Right. But that's, as that stuff's filed, those are great because they want out quick, fast, in a hurry, or they're up against it. They have to sell it, or they have to refinance it. There's an issue there, but a lot of times they want to just sell it and split the cost.
Right.
That's that courthouse data that's great to target because there's motivation there.
You're right.
Whether there's an end date that the property has to be sold by, or something's coming that needs to be taken care of.
Okay. And then tired landlords are always a good one, right? I did have a guy down in Texas that hit a lady. She called, sold him one, called back. She had two more. So we talked. He's like, man, this list is really good. And then we talked the month after that, and he was like, you're not going to believe this. So this lady called back with 6 more. So totaling 9 properties, and she wanted to sell them quick before the end of the year. So actually it worked out really good for them and made their year.
Right. And tired landlords are great because, we've all played the game Monopoly. You buy and sell and trade properties, and that's how they look at them. They could get a bad tenant, don't like the tenant. You could go after the courthouse evictions list. They don't want to deal with the eviction. They'll sell that property off and just go buy 2 more or one other one, or somebody comes through and destroy, they had a tenant destroy it. Well, they don't want to pay. It might cost too much to repair it. So they'll sell it off to a wholesaler, or sell it off to a flipper, and then go buy one that they can just move somebody into that's at a cheaper price point. So, I love absentee and tired landlord lists. I even do a dumb landlord list where, they're probably not in an LLC and they're just kind of do it. Maybe they inherited one property and then they were like, oh, this isn't bad. And then they went and bought 3 or 4 more to offset some taxes and that. And they're like, oh, I just started a whole business and this is overwhelming. But, they don't know a good property management company, or they tried one and they stole money from them or didn't do the things that they were supposed to. So all of a sudden they'll sell off 7, 10 properties all, and they're like, hey, how fast can we get rid of it?
Yeah, it seems like some of these people, they didn't plan on being landlords. It kind of just fell in their lap. And if you send them something that more or less is like a safety net, they'll latch on. Right.
And it's, they saw something on late night TV, or, they heard from a friend of theirs that was offsetting their taxes through real estate. They listened to Donald Trump or all of these successful, billionaires that they did it through real estate. They read a book, things like that. And then they were like, let's go do this. And then they started a whole nother company, but they're not built for that.
Right.
And so they don't have the time, the patience, or they're not doing it right. And oftentimes, as most entrepreneurs do, they'll get started into something and then fail. But good entrepreneurs will start again, but they're starting at a faster point, and then they'll start again and start again till they get it done right. But as they have to, they make a couple wrong turns and they get their backs against the wall, you'll see them, offset their property. I mean, I know a guy that's been in it for 17, 18 years now that does, probably has done more than 3,000 that just got his back put against the wall, had one giant business deal go bad, and now he's selling off 300 to 400 properties, to reset his books and then to start over. So, he fell down a flight of stairs, getting up, dusting himself off and going, but, he's selling off 300 properties.
One guy had a really tight buy box, really tight buy
I've had
box.
some of these too.
Versus, how do you think that compares to somebody with a little bit bigger buy box or a giant buy box?
If you're going to niche down on a buy box and build a really tight avatar of this is exactly you want a big geographical area. And then you want to pay attention to the market to make sure you're staying on it. I had somebody fail the year before last that narrowed their buy box down too far in the Dallas Tarrant County area, the DFW area. They had a giant geographical area, and we were getting all kinds of calls, closing all kinds of deals, and then the market went up. And all of a sudden, the houses that we were targeting are no longer in the buy box, weren't getting inside of the list. We were getting the properties that were just outside underneath the buy box that we were doing before with the market shift. And in doing that, you want your primary list, that you're targeting, and then you want to split test or start testing with other things to make sure you're staying on top of what's good in the area or finding what's next. Because everything has a lifespan. If you go and walk, or I walk out on stage and say, oh man, so-and-so did really good in this area and we got a great response rate and they did a ton of deals. You know what just happened? Competition's going to be flooding to that area. So I've learned the hard way sometimes not to talk about the areas or say a different area than when it was, or a city like. To try to curb the competition. And it's that same thing with geography goes with lists. If you go and talk and say, hey, I have the best list provider in this area, and then everybody starts to use it, well, competition just made your list terrible because, it just waters down the data. So you want to rotate through data sets, you want to rotate through areas and try different things and spread that avatar out. Have it as your main focus, but have a side focus.
I learned a lot. I'm sure anybody listening probably learned a lot as well. But yeah, this was a lot of fun.
Hey, no problem. Feel free to, pick my brain anytime. That's what we're here for. As direct mail marketing coaches and data pullers, we see this stuff all the time. And what that typically looks like is, every day I learn something new in here. So we share that with all of our clients to help them make better decisions.
Cool. I like it.
All right, brother.
Well,
We'll talk
thank
to you later.
Appreciate it.
See ya.
We'll do it again sometime.
Yeah.